A major exchange just flagged coordinated silver trading, while real metal quietly disappears from storage at a speed that should scare anyone watching the plumbing. This is Vantage Economics, and today we're not doing slogans or fortune-telling. We're walking through what was officially stated, what the vault numbers show, and why the next few weeks matter more than the last few months. Quick safety note before we start. This channel will never DM you for money, sell signals, or run funds. If someone uses my name to do that, it's a scam. I'm here for data, context, and calm analysis, especially when the timeline gets noisy. Now here's the sequence that changed the tone overnight. A Chinese futures exchange posted a formal notice tied to abnormal silver activity. They identified multiple clusters of related accounts that pushed beyond intraday opening limits on silver contracts, and they slapped restrictions on new position openings for those groups. In plain terms, the exchange is saying the move wasn't random flow, it looked organized. And that matters because, right before that response, an enormous burst of paper selling hit the session, an amount so large it dwarfs what the physical world can produce in a year. Is that normal liquidity, or is that an attempt to force price discovery in one violent push? As I record, a Western spot and Shanghai pricing are still showing a gap, and the local premium is the part people ignore until it's too late. When price falls but the premium stays stubborn, that the market whispering that paper and pickup truck delivery are not the same product. Here's the first big tension. The exchange crackdown suggests stress on the paper side, but the vault numbers suggest stress on the physical side, and those two stresses don't cancel out, they collide. Let's shift to the US side, because this is where the scoreboard becomes unavoidable. COMEX vault reports showed a noticeable one-day physical draw. At the same time, settlement behavior has been shifting. A much larger share of futures has been translating into actual metal movement compared with the tiny percentages that are typical in calmer years. If futures are mostly a financial game, why are so many players suddenly acting like they want the thing itself? Total inventory has been trending lower, and the registered category, the part generally available for delivery, has shrunk enough that the ratio versus open interest is the headline nobody wants to read on air. Because when claims tower over what's readily deliverable, the system can still function, right up until it can't. And that until can arrive fast when confidence cracks. Now add a third ingredient, margin hikes. The CME has been raising margin requirements again, more than once in a short span, pushing maintenance higher for both gold and silver, with silver getting hit harder. People often misunderstand margins. Higher margin doesn't mean safe. It often means the opposite. Volatility plus counterparty fear. Exchanges don't tighten the screws because they feel relaxed. They tighten them because they're looking at risk models and seeing danger. If this were mainly a gold issue, gold would be punished more. It isn't. Silver is getting the heavier treatment. That asymmetry is information. And here's the part that was easy to miss. You can raise margin on contracts all day long. You can't issue a margin call on missing ounces. Paper rules can restrain paper behavior, but they can't conjure supply. Scarcity doesn't negotiate with paperwork. We also saw open interest shift lower after the sharp sell-off, suggesting forced deleveraging, and yet the positioning still looks large relative to what's sitting in registered form. That's why March is looming as a stress test. So let's do the math that everyone tries to avoid. We're approaching a major delivery window. Open interest represents an enormous quantity of silver exposure. Registered inventories represent a much smaller pool. Even if only a fraction of contract holders request delivery, the implied demand can rival, match, or exceed what's readily available without tapping reluctant holders or sourcing metal elsewhere. And that's the key word, reluctant. Eligible silver exists, but eligible isn't the same as offered. Owners decide whether to convert. If the price is seen as artificially depressed, why would a holder volunteer their bars into the delivery pipeline? They may simply wait. Meanwhile, reports out of Shanghai indicate their vault numbers also dropped hard in a single day, double-digit percentage style. Read that again? Not a slow leak, a sudden bite taken out of inventory. What happens if that pace repeats even a few times? This is why the paper smash narrative doesn't automatically equal bearish. When price drops while inventories drop, you're looking at two different markets expressing two different truths. One truth is printed on a screen, the other truth is a truck leaving a warehouse. When vault's drained, the chart is only half the story. Now we widen the lens because silver isn't trading in a vacuum. A violent risk-off wave has been moving across assets. Crypto got hit hard, and when leveraged positions unwind, the selling doesn't politely stay in its lane. Tokenized metals, ETFs, futures, swaps, anything tied to margin and liquidity can get pulled into the downdraft. That doesn't prove silver is weak. It proves liquidity is being demanded everywhere at once. We saw major equity weakness as well, with heavy institutional selling flows showing up in the tape. When funds de-risk, they sell what they can, not only what they hate. That's an important distinction. Geopolitics has also been tightening the air. Heightened alerts and escalating tensions add another layer of uncertainty. And uncertainty is gasoline for volatility, which then feeds back into higher margins, which then forces more liquidation. It's a loop. So here's the question. Are we watching a normal correction, or the system trying to reduce exposure before a delivery problem becomes undeniable? Now let's talk about physical behavior on the street level, because it often contradicts the screen price. There are reports of lines and crowded counters, buyers in multiple regions stepping in even as prices dip. That seems irrational until you realize many buyers treat price weakness as a supply opportunity, not a fear signal. In their minds, lower price equals more ounces per paycheck. And if they distrust future availability, they act sooner, not later. At the same time, trading volume in major silver-backed products spiked to extreme levels, capitulation-style volume. When volume goes vertical, it usually means forced exits, panicked hedging, or both. That can mark bottoms, but it can also mark the middle of a liquidation cascade. We need confirmation, not hope. Technicals echo that ambiguity. The same price can occur under totally different sentiment conditions. One moment can be euphoric, and another can be despair. If momentum readings are depressed while headlines are screaming, you're often closer to exhaustion than continuation, but often is not always. And now, the crux, the next delivery period. We have recent history showing rising delivery behavior year over year, with minor months turning unusually active. That pattern implies a shift in participant preference away from rolling contracts forward and toward requesting metal. Why? Because when trust erodes, optionality becomes priceless. As we move into the bigger delivery month, scenarios matter. If only a quarter stands for delivery, that's a massive chunk. If half stands, the numbers become uncomfortable. If a larger share stands, the system must either locate additional metal quickly, incentivize holders to make it available, or find alternative settlement outcomes that preserve the exchange's function but may damage confidence. Which path gets chosen depends on stress, optics, and what's actually available behind the curtain. And remember, the drain rate into March matters. If registered continues declining into the window, the cushion thins. A thinner cushion means every unexpected delivery request has a larger impact. So where does that leave us today? 1. A major exchange in China has effectively documented coordinated rule-breaking behavior tied to silver positioning and responded with restrictions. That's not internet speculation. It's an official action that signals concern about market conduct. 2. U.S. exchange margins are being raised again, and silver is bearing the heavier load. That's consistent with volatility and stress, not calm. It also increases the chance of more forced selling in the short term, regardless of fundamentals. 3. Physical inventories and on-the-ground buying behavior keep pointing the other direction. Metal is leaving, premiums exist, buyers show up on dips, and the paper market can't print bars. So the real storyline is a contest between two forces: systemic deleveraging versus physical tightness. If deleveraging dominates first, price can still dip even as the underlying scarcity grows. If physical tightness dominates first, the rebound can be sudden and violent. 3 weeks can feel like forever until it isn't. Watch the vault reports, watch delivery intentions, watch margin updates. And yes, watch broader risk sentiment, because when everything is correlated, silver can get dragged around by forces that have nothing to do with silver. Do your own diligence, know your time horizon. Don't outsource your thinking to hype merchants. If you value steady, evidence-first coverage, please like and subscribe to Vantage Economics so you don't miss the next update as this delivery window approaches. And tell me this in the comments. If paper and physical keep diverging, what do you think snaps first, the price or the rules?